What if everything the bulls said about AI turned out to be completely true? What if AI became more powerful than anyone imagined? What if productivity exploded? What if corporate profits hit all-time records? What if the stock market kept climbing to levels that seemed impossible just a few years ago? What if all of that happened and it still destroyed the economy? That is the thought experiment that a financial research firm called Citrini Research published in February 2026. And it is one of the most chilling, most intelligent pieces of financial writing I have come across in a very long time. It is written as a fake memo from the future, June 2028. And it walks you through, step by step, exactly how an AI-driven economic boom quietly became an economic catastrophe. Let's break it down, because whether or not this specific scenario plays out, the logic is airtight. And if you are an entrepreneur, an investor, or just someone trying to understand where the economy is heading, you need to understand this. Act 1. The setup. A boom that felt real. Picture this. It is October 2026. The S&P 500 is flirting with 8,000. The NASDAQ has broken above 30,000. By every traditional measure, the economy looks incredible. Productivity is booming. Real output per hour is growing at rates not seen since the 1950s. Corporate profits are hitting records. Margins are expanding. AI is everywhere. And here is the thing. The numbers are not fake. The economy genuinely is producing more. AI agents are working around the clock. They do not sleep. They do not take sick days. They do not need health insurance or a 401k. Companies are replacing expensive white-collar workers with AI tools. And in the short term, it is working beautifully. Costs go down, profits go up, stocks go up. More money flows into AI, AI gets better. Repeat. But here is the crack that nobody wants to look at. The authors coin a phrase for what is happening. They call it Ghost GDP. Output that shows up in the national accounts, but never actually circulates through the real economy. Think about what that means. A single GPU cluster sitting in a data center in North Dakota is now generating the economic output that used to require 10,000 white-collar workers sitting in offices in Midtown Manhattan. On paper, the output is the same, maybe even higher. But those 10,000 workers had rent to pay, groceries to buy, restaurants to visit, cars to service, kids in school, vacations to book. The GPU cluster does none of that. How much money does a machine spend on discretionary goods? The authors ask this directly, and the answer, of course, is zero. Act 2. The spiral begins. So what happens when you start replacing highly paid humans with machines at scale? The authors describe what they call the human intelligence displacement spiral. Here is how it works. AI capabilities improve. Companies need fewer workers. White-collar layoffs increase. Displaced workers spend less money. Companies selling to consumers start to struggle. Margin pressure pushes those companies to invest more in AI. AI capabilities improve further. Round and round it goes. And here is the brutal part. There is no natural break on this loop. In a normal recession, say the housing crash of 2008 or a pandemic, the cause eventually self-corrects. You overbuild, you stop building, rates come down, you build again. The cycle has an engine for recovery built right in. But when the cause of job losses is AI getting smarter and cheaper every quarter, there is no self-correction. The thing causing the problem just keeps getting better at causing the problem. The authors describe it plainly. AI got better and cheaper. Companies laid off workers, then used the savings to buy more AI capability, which let them lay off more workers. Displaced workers spent less. Companies that sell things to consumers sold fewer of them. Weakened invested more in AI to protect margins. AI got better and cheaper. A feedback loop with no natural break. Act 3. The SaaS collapse. Now let's talk about one of the most surprising parts of this scenario. Because you might think, okay, some white-collar workers lose jobs. That is painful. But it does not necessarily destroy the whole economy. Here is what the author saw that most people missed. In late 2025, agentic coding tools take a major leap forward. A skilled developer working with tools like Claude Code can now replicate the core functionality of a mid-market software product in weeks. Not perfectly, not with every edge case handled, but well enough that the person who signs the checks starts asking the question, what if we just built this ourselves? The authors tell a story, fictional but very plausible, of a procurement manager at a Fortune 500 company. A software vendor shows up, expecting the usual routine, 5% price increase. The standard pitch, your team depends on us. The procurement manager tells the salesperson he has been in conversations with OpenAI about having their engineers use AI tools to replace the vendor entirely. They renewed at a 30% discount. And that, the procurement manager says, was a good outcome. The long tail of SaaS, companies like Monday.com, Zapier, Asana, had it far worse. But here is where the story gets really interesting. Investors had already priced this in for the small players. Everyone knew the commoditized SaaS tools were vulnerable. The assumption was that the big enterprise systems, the core platforms companies absolutely depended on, were safe. That assumption died in October 2026. ServiceNow, one of the most beloved enterprise software companies in the world, reports that its growth has decelerated sharply, from 23% to 14%. It announces a 15% workforce reduction, shares fall 18%. But here is the twist that most people missed. ServiceNow was not just being disrupted by AI from the outside, it was being destroyed from the inside out. ServiceNow sells seats, licenses for its software, based on how many employees a customer has. When its Fortune 500 clients cut 15% of their workforce because of AI, they canceled 15% of their ServiceNow licenses. The same AI wave that was boosting profit margins at ServiceNow's customers was mechanically destroying ServiceNow's own revenue base. The company that sold workflow automation was being disrupted by better workflow automation, and its only rational response was to cut its own headcount and use the savings to fund the very technology that was disrupting it. The authors pause here and say something that I think is one of the most insightful lines in the entire piece. The historical disruption model said incumbents resist new technology. They lose share to nimble entrants and die slowly. Kodak, Blockbuster, BlackBerry. What happened here was different. The incumbents did not resist. They couldn't afford to. With stocks down 40 to 60% and boards demanding answers, the threatened companies did the only rational thing: cut headcount, buy more AI, maintain output with lower costs. Each company's individual response was rational. The collective result was catastrophic. Act 4. When friction went to zero. Okay, software getting disrupted. That is one thing. But what happens when AI agents start running your entire consumer life? By early 2027, AI agents have become so embedded in everyday life that people are using them without even knowing what an AI agent is. They think of it the same way they think of autocomplete or spell check, a thing their phone just does now. Then something called agentic shopping goes mainstream. An open-source AI shopping assistant starts making purchasing decisions on behalf of consumers. Within weeks, every major AI assistant has a version of this. And here is the key detail. These agents do not wait to be asked. They run in the background, continuously, optimizing every purchase, every subscription, every financial decision, 24 hours a day, 7 days a week. And what these agents are brutally, ruthlessly good at is eliminating friction. Now, friction might sound like a small thing, but the authors make a profound point here. Over the past 50 years, the entire American consumer economy built itself on top of human limitations. Things take time, patience runs out, brand familiarity substitutes for doing real research. Most people will accept a bad price just to avoid more clicks. Trillions of dollars of enterprise value depended on those human quirks persisting. The authors run through the examples. Travel booking platforms. By the end of 2026, an AI agent can assemble a complete trip: flights, hotels, ground transport, loyalty points, refunds, faster and cheaper than any booking platform. Travel booking platforms become obsolete almost overnight. Insurance renewals. The entire renewal model depended on you being too lazy to shop around. An agent that automatically reshops your coverage every year dismantles the 15 to 20% of premiums that insurers were quietly collecting from passive customers. Real estate commissions. Buyers had tolerated 5 to 6% commissions for decades because the agent had information the buyer did not. The moment an AI agent with full access to transaction data can replicate that knowledge instantly, the median commission compresses from 2.5% to under 1%. And then the authors describe what they call habitual intermediation, a particular kind of business moat that disappears entirely when AI is doing your shopping. DoorDash becomes the poster child. The DoorDash moat, as the authors put it bluntly, was literally this: you are hungry, you are lazy, this app is already on your home screen. An agent does not have a home screen. It checks DoorDash, Uber Eats, the restaurant's own site, and 20 newer alternatives simultaneously. It picks the lowest fee and fastest delivery every time. Habitual app loyalty, the entire basis of the DoorDash business model, simply does not exist for a machine. Act 5. From sector risk to systemic risk. By 2026, most investors were treating all of this as a sector story. Software is getting hit. Some consumer platforms are struggling, but the broader economy looks fine. The authors say this was the wrong mental model. Here is the key insight. The United States is a white-collar services economy. White-collar workers represent 50% of employment, but they drive roughly 75% of discretionary consumer spending. The jobs AI was eliminating were not peripheral to the American economy. They were the American economy. And then the authors address the most common counterargument. You have probably heard it. Technology always destroys jobs and then creates new ones. A TMS made bank branches cheaper to run, so banks opened more of them, and teller employment actually rose. The internet disrupted travel agencies and the Yellow Pages, but it invented entire new industries that created far more jobs than were lost. The authors acknowledge this argument. They say it has been correct for 2 centuries. But here is why this time is different. Every new job created by previous waves of automation still required a human to perform it. AI is a general intelligence that improves at the very tasks humans would redeploy to. Displaced software engineers cannot simply move into AI management roles because AI is already capable of AI management. Displaced analysts cannot simply become prompt engineers at scale because the number of prompt engineering jobs is nowhere near the number of analyst jobs that disappeared. For every new role AI creates, it renders dozens obsolete, and the new roles pay a fraction of what the old ones did. Act 6. The Daisy Chain. Now the story enters its most dangerous phase, because what starts as an economic problem becomes a financial crisis. Private credit, the world of private equity firms making loans to businesses outside the traditional banking system, had grown from under $1 trillion in 2015 to over $2.5 trillion by 2026. A significant chunk of that money had been deployed into software and technology deals, leveraged buyouts of SaaS companies, loans structured around the assumption that annual recurring revenue would remain recurring forever. That assumption dies somewhere between the first agentic coding demo and the Q1 2026 software crash. But the financial marks, the official valuations on paper, do not reflect this. The authors tell the story of Zendesk. In 2022, private equity firms took Zendesk private for $10.2 billion. They loaded it with $5 billion in debt. The entire loan was underwritten on one assumption, that Zendesk's annual recurring revenue would stay stable. By mid-2027, AI agents have been handling customer service autonomously for the better part of a year. The category Zendesk had defined, ticketing, routing, managing human support interactions, has been replaced by systems that resolve issues without ever generating a ticket at all. The revenue the loan was written against is no longer recurring. It is just revenue that has not left yet. The largest ARR-backed loan in history becomes the largest private credit software default in history. And every credit desk in every major financial institution asks the same question at the same time. Who else has a secular headwind disguised as a cyclical one? But here is what makes this worse than just a bad loan. The authors peel back a layer that most people did not see. Over the prior decade, private equity firms had bought life insurance companies and turned them into funding vehicles. Apollo bought Athene. Brookfield bought American Equity Life. KKR took Global Atlantic. The logic was elegant. Annuity deposits from ordinary American households provided cheap, stable funding. The PE firms invested those deposits into the private credit they originated. They got paid twice: management fees on one side, investment returns on the other. A perpetual motion machine that worked beautifully under one condition. The private credit had to be money good. The losses hit balance sheets built to hold illiquid assets against long-duration obligations. The so-called permanent capital that was supposed to make the system resilient was not some abstract pool of patient institutional money. It was the retirement savings of American households, structured as annuities, invested in the same PE-backed software debt that was now defaulting. When the loans started going bad, insurance regulators stepped in. They required the insurers to hold more capital against these assets, which forced the insurers to either raise capital or sell assets, neither of which was possible at reasonable prices in a market already seizing up. Apollo's stock dropped 22% in 2 trading sessions. Brookfield, KKR, and the rest followed. Act 7. The mortgage question. And now we reach the part that the authors themselves call the most acute stage. The U.S. residential mortgage market is approximately $13 trillion, and mortgage underwriting is built on one fundamental assumption: the borrower will remain employed at roughly their current income level for the duration of the loan, 30 years in most cases. The white-collar employment crisis has shattered this assumption. And here is what makes this different from every prior mortgage crisis in American history. In 2008, the loans were bad on day one. Banks had made loans to people who could never afford them, subprime borrowers, no documentation, no money down. In this scenario, the loans were good on day one. The borrowers have 780 credit scores. They put 20% down. They have clean credit histories and stable incomes that were verified and documented. They were the safest borrowers in the financial system. The world just changed after the loans were written. People borrowed against a future they can no longer afford to believe in. By June 2028, home values are falling 11% year over year in San Francisco, 9% in Seattle, 8% in Austin, the highest concentration of tech workers, the highest concentration of people whose incomes were most exposed to AI displacement. The authors note that early stress signals had been visible for a year. People borrowing against their home equity, draining their 401s, running up credit card debt, all while mortgage payments were still technically current. These borrowers were making their mortgage payments, but only by stopping all discretionary spending, draining their savings, and deferring any home maintenance. Technically, fine. One more shock away from crisis. Act 8. The lesson for right now. And here is where the authors break the fourth wall. They step out of the fictional June 2028 memo, and they speak directly to you, the person reading this in February 2026. The S&P is near all-time highs. The negative feedback loops have not begun. We are certain some of these scenarios will not materialize. But they say this: as investors, we still have time to assess how much of our portfolios are built upon assumptions that will not survive the decade. As a society, we still have time to be proactive. The Canary is still alive. The 3 lessons for entrepreneurs. So, what does all of this mean for you, building a startup in 2026? Lesson 1. Every moat built on human friction is now temporary. If your business model depends on customers being too lazy, too busy, or too uninformed to find a better option, an AI agent is going to find that better option for them, and then route around you entirely. DoorDash's moat was a home screen. Insurer's moat was renewal laziness. Travel platform's moat was search effort. All of it went to zero. The question to ask about any business is this: what happens to our revenue when the customer has a tireless, perfectly informed AI agent negotiating every decision on their behalf? Lesson 2. The reflexive loop is real, and it is ruthless. The most chilling insight in this entire piece is not about technology. It is about corporate behavior. Every company threatened by AI becomes AI's most aggressive adopter. ServiceNow cuts workers, uses the savings to buy AI, which makes the next round of cuts possible. This is individually rational and collectively catastrophic. We are already seeing early versions of this. The question for founders is whether you are building on the side of that loop that gets more powerful or the side that gets eliminated. Lesson 3. Ghost GDP is the concept you need to understand. Output can exist without circulation. An economy can be productive without being healthy. For entrepreneurs, this means understanding the difference between building something that generates real economic activity, transactions, employment, wages that circulate, versus something that concentrates value at the top of a very narrow funnel. The markets will eventually figure out the difference. Closing. The authors end with a line that I think deserves to sit with you for a moment. This is the first time in history the most productive asset in the economy has produced fewer, not more, jobs. Nobody's framework fits, because none were designed for a world where the scarce input became abundant. For 2 centuries, human intelligence was the scarce, valuable thing. Every institution we built, the labor market, the mortgage market, the tax code, the entire consumer economy, was designed around that assumption. AI is not a faster calculator. It is the first technology in history that improves at the very tasks displaced workers would redeploy to. Whether the 2028 scenario plays out exactly as described is almost beside the point. The logic is the point. The feedback loops are real. The friction-dependent business models are real. The assumptions baked into $13 trillion of mortgages are real. And right now, in early 2026, you still have time to think clearly about which side of this you are building on. The Canary is still alive. Think carefully about what you are building.